Welcome to Enrich Investments, where we place investors in excellent real estate opportunities. This will be one of the first of many discussions about commercial real estate that will benefit you as an investor and someone looking to save taxes and grow wealth and enjoy a better quality of life. Are you a healthcare professional making good money but losing most of it to taxes? Real estate investing can make you money and significantly reduce your tax burden. I'm sure you're a healthcare professional who is earning good wages, but you are probably losing a significant amount of your income to taxes. Did you know that you can save significant amounts of money on your taxes by acquiring an income-producing property, while at the same time receiving cash flow and building equity for the future? Through the course of a year, the average healthcare professional earns ordinary income in the form of wages, interest, and dividends. All of this income is taxable, but against this income, certain exemptions and deductions are allowed so that you could end up paying tax on a lesser amount than what you earned. Many healthcare professionals are not fully aware of the tax benefits related to real estate investments. Consequently, you probably pay far more to the government than you should and have far less cash available. There are a number of tax deductions available to people who invest in real estate. You can also build a solid real estate portfolio while avoiding the capital gains taxes. The first deduction is an interest deduction. In most cases, interest is tax deductible as an expense. You can write off every dollar of interest paid, dollar for dollar, against income. Let's say, for example, you earn $100,000 of income in a single year, and during the same year you pay $20,000 in interest on a piece of real estate. The $20,000 can be deducted from the $100,000 that you earned, leaving you with only $80,000 in taxable income. Your biggest tax break is your monthly mortgage payment. Usually the bulk of each mortgage payment goes toward interest, and 100% of that interest is deductible. The tax breaks can go far beyond your first mortgage. If you use your real estate's growing value to pull out cash through refinancing or a home equity loan, that interest is also going to be deductible. The next deduction is called a point deduction. Points are also deductible. Points are added to loan fees charged by lenders. The IRS treats points as prepaid interest on a loan so that they are fully deductible to the party that pays them. They are deducted over the life of the loan for investment properties and deductible in the year incurred if paid on your primary residence, subject to certain requirements. Another important deduction is the depreciation deduction. Depreciation is an annual tax deduction that investors may take under the assumption that each year the building and other property decays, becomes unusable, or obsolete. For residential property, the depreciation time period is 27.5 years. Amazingly, you are entitled to depreciate your property even if your property goes up in value over time. Only the improvements to land are depreciable, so the value of the land must be deducted from the purchase price to figure out the basis for depreciation. For example, let's say you purchase a rental property for $200,000 and the land is worth $50,000. Deducting the value of the land from the purchase price would give you a depreciable basis of $150,000. Each year you would be entitled to deduct 1/27th of the value of the improvements, or in this example, $5,454 from your income. By owning an income-producing property, you can also depreciate personal property in the building. For instance, the stoves, the refrigerators, the sinks, the rugs, etc., using often accelerated depreciation schedules which provide larger depreciation deductions in the earlier years rather than the straight line method. Let's take this investment scenario. Let's say you're looking for an investment with a before-tax return of 9%. You purchase a cash flow property worth $250,000. The land is valued at $50,000, and the building and structures are worth $200,000. There are 4 units, each consisting of 2 bedrooms and 1 bath that will rent for $650 a month each unit, bringing in gross potential income each month of $2,600. Let's further assume that you have a marginal tax rate of 35%. Because you're a busy professional, you'll probably have a property manager and will therefore be deemed a passive investor. Let's further assume that property taxes will be 1.1% or $2,750 per year. Property management fees will be 7% of the effective gross income, which is the income derived after subtracting vacancy and credit losses, or $182 a month. Insurance will be $2,000 per year. Maintenance costs will be $1,400 per year. Utilities will be $1,400 per year. And rents will start at $650 per unit per month, increasing 3% each year. We'll assume for sake of this example we have no vacancies and mortgage fees and points are $2,500. In order to purchase your building, you will obtain financing with a 15% down payment equivalent to $37,500, and you will obtain a loan of 85% or $212,500 payable at 6% interest per year. The loan will be amortized over 30 years with a term of 30 years as well. At the end of 5 years, you will sell the property, in this example, and the selling price will be based on a projected annual growth rate of 8% with sales commissions at 5% of the sale price. Our projected sale price will be $367,330. Here's a snapshot of what the first year tax deductions would look like in this scenario. Some observations for the first year. What is apparent is that you have enjoyed net operating income of $21,462 during the year, but you've paid no taxes on that income. Deducted from net operating income were your principal and interest payments on your loan, and deductions for depreciation and amortization of $9,467. Had you earned that as a nurse or healthcare professional, had you earned the $21,462 and assuming a 35% tax bracket, you would have paid $7,512 in taxes. Because you have an investment property, you were able to pay back $2,609.59 in principal the first year, meaning that you gained an additional $2,609.59 in equity on your property. From a cash flow perspective, you invested $37,500 with an after-tax cash-on-cash return in year 1 of 16.3%. Your internal rate of return over the course of your 5-year investment would have been 37.18% after tax. Because you told us you wanted a 9% return on your investment, you could have paid an additional $87,210 more for the same property and still reached your investment goals. Let's look at how you did. It's very clear that your total benefit by having an investment was $41,462, and without an investment, just earning ordinary income with no deductions, you actually had to pay $7,512 in taxes. We hope you enjoyed this presentation and that you will get involved with commercial real estate investing And if you'd like to learn more about commercial real estate investing, please visit us at enrichinvestments.com or contact us regarding your investment interests. Enrich Investments specializes in finding and evaluating cash flow properties in emerging markets to provide you with excellent real estate opportunities. Why not contact us today for a free consultation to discuss your investment goals? We look forward to working with you in the near future.